Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing out there? Hope you're having a good day. I got a little tan. See my tan? It's like, actually I look kind of oily, but you don't care about that. You're here to learn about your money. And today we're going to talk about something a little bit maybe not interesting on the surface, but think about it for a second. Oftentimes we read through, new proposals, IRS codes, earnings and things like that from companies, and you go, whatever. But if you think about it, you may find that there's something of a strategy there. This won't apply to everybody, but it's just to show you how to think of things differently. So in the Secure Act, and I'm drawing a blank, I believe it was the Secure Act, there was a little rule in there that says because of COVID, if an employer wants to contribute to an employee's 401k, they would have up to the employer's filing date of the next year to do it. Basically, normally an employer has to contribute to your 401k in that year, right? If they match something or if they give you an elective sort of profit-based, match, and that's what they call it. All right, fine. But employers can now say, it's 2022, and we would like to take some money and put it in the employer's 401k for 2021 if we haven't filed our taxes yet. Most corporations will file an extension for their taxes and file later, so it could mean as late as October that they'd be allowed to do this because the rule says up to the deadline of whenever they actually file. The final deadline's October, right? So we got to do it by then. So I read that and I'm like, all right, don't know why that matters. But if you think about it for a second, what if you're an employee of your own company? You have, hopefully, a profit. You've got some money going on here in 2022 that you could back out to 2021, but benefit from it individually. There's no tax write-off for you as the employee, but let's do an example here. So if I go over here and hit this button, let's say you've got your company, right? And you want to take $5,000. I'm just picking random numbers. This doesn't mean anything here. But you're also the employee, right? And you go, we'd like to take this money, put it in the employer's employee's account for 2021, right? This is 2022 money right here. And your part owner, majority owner, whatever it is that you are, this money's going over here into the 401k, which means the employer, which is you as the owner and stuff, could do another $5,000 for 2022, move it over into this for 2022 401k, right? Why does that matter? Who really cares? Is there a strategy there? Yeah, there's all kinds of stuff you can do. One of the obvious ones is, as a company, you're not distributing that money, which then becomes taxable. You're allowed more money to move over to the 401k. It doesn't really matter so much if it's a small amount like this, but if you're starting to contribute larger and larger amounts, or you need to get some money off the books, you're allowed to. It's a one-time thing, right? It's not going to happen again next year. Again, the key to this is you can't have already filed your taxes, right? Like I said, I'm only doing this because I know most companies, the rule, most accountants will tell you file an extension for your company because the percentage of companies that get audited that have filed an extension is dramatically lower. It was like 8% or something relative to those that file their taxes on time. Those companies tend to get audited more. I don't know if there's any truth to that, but it doesn't hurt to just file an extension, I guess. And if your CPA wants you to do it, so be it. But in this case, if you did file an extension, you got at least a little bit of a benefit there. You get some money off the books from the corporation, put it into the 401k for 2021. Then if the end of this year comes along and you still have some extra money, get that money off the books, get it into the 401k. It's your 401k. Now think about this for those of you that have multiple employees. You can't just say, I'm going to take all that money, put it into my 401k and call it a day. $20,000, here we go. You can't do that. I'm actually not familiar with the exact ruling on how much has to go into each account if you have various employees. You're going to want to check with your CPA on that one. I honestly don't know. I'll just throw my hands in the air and say, not my wheelhouse, right? But it's an opportunity. And for those of you that go, I'm not an employee of my own company that I own, then the lesson today is don't take any word in any proposal or the IRS code for granted. You never know when that may apply to you or somebody you can help, or maybe it's your wife starts a business, she's an employee of her own company, etc., whatever. Don't just browse over stuff and assume that that's for the rich people. That's for somebody else. Oh, there's something there. Practice on these strategies, even if you don't do them, so when the time comes, you go, I'm well within my rights to do that. There's an old joke where you say, the IRS only asks you for what you owe, right? It's your problem if you pay more to them than they ask for. They're not going to give it back, right? You just pay it in, they go, we'll take your word for it, right? So work on things like this to make every little dollar go into your pocket legally, that you can, instead of just blindly going, well, I got a guy, he takes care of it, or I use TurboTax, right? Dig deeper. Dig deeper with your dollars, because as you see the Fed raising rates here, dollars are going to be less easy to come by. The velocity of a dollar is slowing down. You know what that means? It'll be a little bonus point here if you want to watch this part. The Fed tracks the velocity of a dollar, meaning how fast did you get that dollar and then throw it towards something you needed, wanted, or just maybe both, I don't know. So they track that. The velocity of the dollar was at the highest level that it's ever been, that as far as back as they've tracked anyways. So that means that when you got a dollar, you basically already spent it. You were enjoying life, going on those cruises, wearing your mask, and happy just to be back on a cruise again, right? The velocity of dollars is slowing down now, meaning people get a dollar and they're less likely to quickly get rid of it there, right? So we know that that's happening in the economy, in the world right now. So it's not going to be all like sugar plum fairies and icing cakes or whatever they say. So learn to try to find interesting ways to keep your dollars within the law. Of course, I think I have to say that, right? And anyways, just thought that would help. A different way to explain something for the day. I was reading about it and I thought, well, I'll share that with everybody because that seems kind of interesting. If you found it helpful, hit the thumbs up button, hit the subscribe button, all the good stuff that we like to hear you do. And I'll see you later on the Closing Beat. We also do Wine and Wealth. That'll be tonight for our clients, actually, at 8 o'clock. That's private for our clients, where we talk about all kinds of different things to help them keep growing their dough, all the fun stuff we can get more specific about. And I got a good one for tonight. So you enjoy the rest of your day. Thank you so much for watching, and we'll see you.
Hey, you made it to the end. That's awesome. Well, if you want to check out more geeky stuff, be sure to check out that video over there. Also, if you could subscribe, that really help us out. We're financial advisors that love to teach, and you'll find all kinds of free stuff on our videos. And remember, keep your dough straight. Yeah, I did it. You did. That was it.